Are you tired of the same old retirement advice that leaves you feeling anxious and unprepared for the future? In this video, we're exploring 5 investment strategies for retirement that most people don't talk about. These methods can help you grow your savings in ways you might not have considered. Whether you're just starting your career or getting close to retirement, it's never too late to make smart choices for your financial future. Stick with us as we go through these exciting options, particularly number 5, which can lead to tax-free money in retirement. Let's start with tax-advantaged accounts. Many people know about traditional retirement accounts like 401ks and IRAs, but few fully maximize them. A lesser-known option is the health savings account, HSA, especially for those with high-deductible health plans. HSA contributions are tax-deductible, grow tax-free, and can be withdrawn tax-free for qualified medical expenses. This triple tax advantage makes HSAs a powerful financial tool, potentially serving as a supplemental retirement account. With rising healthcare costs, a dedicated fund for medical expenses can ease financial burdens that often come with aging. Paul Ryan, the former Speaker of the House, has been a vocal advocate for HSAs, recognizing their potential to empower individuals in managing their healthcare costs. He has consistently emphasized their role in promoting health savings and enhancing financial security for retirees. By encouraging the use of HSAs, Ryan highlights how these accounts allow individuals to take control of their healthcare spending while simultaneously preparing for their future. He argues that with careful planning and regular contributions, individuals can significantly enhance their retirement funds, ensuring they have the financial flexibility needed to address healthcare needs in their golden years. HSAs benefit retirees and play a crucial role in financial planning. They encourage individuals to think about the long-term effects of healthcare choices and promote proactive health management. By saving for healthcare expenses, people can better navigate health insurance complexities and rising medical costs. HSAs not only help save for future expenses, but also promote financial literacy and responsibility. As awareness of HSAs grows, individuals can make informed decisions that enhance their financial wellness and lead to a more secure, stress-free retirement. Next up, let's talk about target date funds, investment options that are often overlooked, but can be a great choice for retirement savings. These funds are designed to automatically change their mix of investments based on your expected retirement date. For example, if you plan to retire in 2035, you would choose a fund aimed at that year. At first, the fund will invest more heavily in stocks to encourage growth and increase value. This aggressive approach is ideal for younger investors who have time to handle market ups and downs. However, as you get closer to retirement, the fund slowly shifts its focus towards safer investments like bonds and cash. This gradual reduction in risk helps protect your money as you approach the time when you'll start using those savings. The appeal of target date funds lies in their easy, hands-off approach to investing. Many people find it hard to manage their investment accounts actively due to busy lives or a lack of financial knowledge. Target date funds make this easier by providing a professionally managed investment solution that adjusts its strategy automatically over time. This feature makes them especially suitable for busy professionals or anyone who wants a simpler way to save for retirement without the constant need for checking and decision-making. Warren Buffett, one of the most successful investors in history, has often pointed out the benefits of diverse, low-cost investment strategies like index funds and target date funds. While he is famous for his stock-picking skills, Buffett understands that these funds can be a smart choice for everyday investors looking for a balanced way to save for retirement. His support adds to the credibility of target date funds, especially for those who may not have the time or knowledge to manage their investments actively. Now let's talk about dividend growth investing. While many investors chase high-yield dividend stocks, focusing on companies that regularly increase their dividends can be more beneficial long-term. Dividend growth investing targets companies with a history of raising dividends, strong fundamentals, reliable cash flow, and steady earnings growth. This approach can create a stable income stream, resilient during market downturns, as these companies often show stability even in tough times. Reinvesting dividends also compounds growth, potentially leading to substantial wealth accumulation. A great example of the effectiveness of this approach is John Neff, a well-known investor and fund manager recognized for his focus on dividend growth investing. Neff managed the Vanguard Windsor Fund for over 30 years, achieving impressive returns through a disciplined investment strategy that centered on finding undervalued companies with strong dividend histories. His strategy highlighted the importance of identifying financially healthy companies that could consistently reward investors over time. Neff believed that a well-chosen group of dividend-growing stocks could provide a mix of income and capital appreciation, offering the investors the potential for significant long-term gains. His success not only showed the viability of dividend growth investing, but also demonstrated how patient investors can benefit from holding quality stocks over long periods. Our fourth strategy is investing in real estate investment trusts, or REITs. REITs allow you to invest in real estate without directly buying properties. They provide exposure to real estate markets while generating income through dividends. Many REITs specialize in specific sectors, like commercial real estate or healthcare, offering diverse investment opportunities. This strategy can add a layer of diversification to your retirement portfolio, potentially increasing your overall returns and providing a hedge against inflation. Donald Trump, a well-known businessman and former president, has made a significant portion of his wealth through real estate investments, including REITs. He has often discussed the benefits of diversifying investments into real estate to generate passive income. Investing in REITs can provide retirees with a steady income stream while diversifying their portfolios away from traditional stocks and bonds. Lastly, we have the Roth conversions, a strategy that many people may overlook when planning for their retirement. While contributing to traditional retirement accounts is common, understanding the advantages of converting some of those savings to a Roth IRA can be a game changer for your financial future. With a Roth IRA, your contributions are made with after-tax dollars, meaning that any withdrawals you make during retirement will be completely tax-free. This can provide a valuable source of income in your later years without the burden of tax liabilities. Converting a portion of your traditional retirement savings to a Roth IRA can be a strategic move, especially if you anticipate being in a higher tax bracket during retirement than you are now. By paying taxes on the converted amount at your current rate, you can potentially save a significant amount in taxes down the line. This approach not only allows for better tax planning, but can also enhance your overall financial flexibility during retirement. Furthermore, Roth IRAs do not have required minimum distributions, ERMDs, during the account holder's lifetime, allowing your money to grow tax-free for a longer period. Tony Robbins, the motivational speaker and author, has often discussed the importance of Roth IRAs and Roth conversions in his financial advice. He emphasizes the long-term benefits of tax-free income and encourages individuals to explore this strategy as part of a comprehensive retirement plan. Robbins' insights highlight how proactive financial planning can lead to greater financial freedom in retirement. If you found these investment strategies helpful, imagine how much more you could learn by subscribing to our channel, and be sure to check out our next video, The Best Investments You Can Make in Your 20s to Retire Early. You won't want to miss it. Let's make your retirement dreams a reality together.